Thank you and welcome. We're excited today to have our education and construction contracting class all about financial statements. And today we have Pete Miller, who's a shareholder at Clark Newber. And Pete has been a tremendous resource for Washington PTAC and the Northwest SBTRC on providing these educational classes to the whole region, the Olympic Peninsula, and also up and down I-5. And I'd also like to recognize Aisha Kadri. She is here from the Northwest Small Business Transportation Resource Center, and Andrew Miller, who is also from the SBTRC. And with that, I'll turn this over to Lori for just a moment to welcome everybody here, and then we'll move on to Pete.
Yes, good morning. And once again, I want to thank everyone for being on the call. I don't know if I see Erica yet. I did welcome Pete and Christine this morning. We are super excited to learn about this educational piece that you will be providing today. So thank you again, and we'll go ahead and let you take it away.
Sounds great. Thank you so much. Appreciate the opportunity to be here. It's my pleasure to present this today. Again, my name is Pete Miller. I work at Clark Newber. Clark Newber is a local public accounting firm based in Bellevue. We're about 250 people. Actually, this year marks our 70th year in business, 70. So pretty exciting about that. I've been with the firm for 22 of those years. Started at Clark Newber right out of school, and it's been a wonderful place to call home. One of the neat things that I really value about my firm is our support for our employees to give back to the community. And I've served on a number of boards over the years, and they've always been supportive of that role and the growth that can come personally from those opportunities. And currently I serve on the local school board where my kids go to school and where I live, and getting a lot of wonderful work done there, making a difference for kids in classrooms and helping them be successful in their future. So the idea of providing education today is right up my alley. So anyway, again, appreciate the opportunity to be here. So what I want to talk about today, a little bit about how accounting information is used. And the title of the presentation is Financial Statement 102, kind of thinking that a 101 type of class might be more in line with, say, bookkeeping and how to maintain your books and how to build a set of financial statements. And what I want to talk about today is more about what are the financial statements telling us? How are others using it when you provide it to them? And then also wanted to talk about some CPA reports on financial statements. So from time to time, users of financial statements like banks and surety bond providers want to have some third-party independent validation of your financial statements. So I'll talk a little bit about that as well. So the basis of accounting is kind of important, and there's some terms that get thrown around there that different users want to see financial statements prepared on a particular basis of accounting, which really depends on the purpose and the use. There's three common bases of or uses of accounting. The one that I see the most is what's referred to abbreviated as GAAP, generally accepted accounting principles. So you'll hear about GAAP financial statements. These are just like it sounds. They're the kind of rules of the road for accounting that are generally accepted across the country. So it's a wonderful way to be able to compare apples to apples, that the way that you account for your contracts and the revenue that you receive from those contracts is going to be the same as your neighbor or competitor or other marketplace participant. So that's helpful for users to know that they're seeing things on the same basis. Another basis of accounting is the federal income tax basis of accounting. The Internal Revenue Code governs how we account for things for federal income tax purposes, which is different in many respects compared to what's recorded for GAAP. A good example of that is depreciation. So you buy a piece of equipment. For GAAP purposes, generally speaking, you will recognize the cost of that equipment over the useful life. Let's say a piece of equipment is going to last you 5 years and you paid $100,000 for it. You're going to recognize $20,000 of expense over that 5-year period each year. In the world of federal income tax, sometimes you can recognize that entire $100,000 right away. And all in the first year, or a big chunk of it in the first year, just because of the way that the federal government is trying to incentivize equipment purchasing and things of that nature. So there's big difference in how things get accounted for. So we got to make sure that we're on the same page. And then thirdly is this managerial accounting, kind of internal accounting, which could be different from GAAP, could be different from federal income tax for sure. So, but what we're going to be talking about today primarily is going to be this GAAP accounting. So GAAP is a major tenet of GAAP is that it's based on historical costs. So like I said before, if you buy some inventory, you buy some sheet metal, for instance, and there's $100 a sheet is what you paid for it. 6 months from now, maybe that is worth $120 a sheet. You don't adjust your books based on what the current market value of that inventory is today. You keep your books on a historical cost basis. So if I paid $100 for it, it's showing up on my balance sheet as a $100 piece of inventory. That's a big part of how GAAP operates for the most part. There's 4 required financial statements that come along in a CPA report that we typically see. A balance sheet, which is a snapshot as of a point in time. What are my assets and liabilities? The income statement is kind of the score sheet, your performance over a period of time. And then there's a couple of accounts on the balance sheet that users and CPAs like to zoom in on. One is the retained earnings or owner's equity piece. We like to see what kinds of transactions are happening in there. I'll talk more about these in detail in a minute. And then secondly is the cash balance. How are you generating cash? How are you using cash? Are you making money? Are you not making money? Those kinds of things. And again, we'll talk more about that here in a second too. But these are the 4 major financial statements that come along in these. So first, let's jump into the balance sheet. And so there's a fundamental accounting equation that is assets are equal to liabilities plus owner's equity. And that's what a balance sheet is telling us. So the kind of refer to this as the left side and the right side, but on the left side of the balance sheet are your assets. And so these are things that you either own outright or that you have the rights to, and generally that, things that will be converted to cash. And you have a right to that cash. So accounts receivable is a good example of that. That is, you've sent an invoice to your customer, but they haven't paid it yet. So that's referred to as a receivable. You've earned that money. You have a right to that money. You've sent an invoice evidencing that, but you haven't received it yet. So it's an asset, but it's just not here yet. Work in process is very similar to that, but it's kind of the precursor to the invoice. You've done the work. You've earned your paycheck as far as that goes, but you haven't yet sent an invoice. So generally accepted accounting principles allows you to recognize that revenue, even though maybe you haven't sent the invoice, and it's captured in this work in process account. So that's something else. Inventory, things that will go into your projects, lumber, sheet metal, other materials. Property and equipment. So, heavy equipment you're using on your jobs that you've purchased, vehicles. Many of my clients have a vehicle fleet that they use to service their contracts, and the like. So that's the left side. On the right side of the balance sheet are the other 2 components, liabilities and equity. Liabilities are accounts payable. So these are invoices that you've received that you owe to your suppliers and vendors. Accrued expenses are things that generally don't have an invoice or you haven't received one yet. And an example of that might be your payroll costs. If you've incurred payroll costs through a month, but your payday for your employees isn't until the 5th of the month, at the end of the month, you've got some accrued payroll costs that you've got an obligation there. You just haven't paid it yet. So that's what that's about. And then long-term debt. We break it into two parts, a current portion and a long-term portion. And then equity is kind of what's left over. If you have issued shares of stock, if you're an S corporation and you have shares of stock, that gets captured there. And then retained earnings is kind of the leftovers. It's what's remaining in the business, the value of the business that's remained in the business. So I've got a couple brackets here. Something I want to point out is this idea of current assets and current liabilities. In GAAP, current means something very specific. And what we're referring to there is a 12-month period of time, generally speaking. So we like to think about things that are going to happen in the next year and things that are going to happen beyond that. And there's an idea of something called working capital that a lot of users of financial statements really care about, and it's something that they pay attention to. And it's a measure of, how able are you as a business to pay your bills? And so it's just simply current assets minus current liabilities. And if that's a positive number, then you're paying your bills, and that's good. Typically, we like to see a little bit of cushion. And so there's, you look for X dollars of working capital, or you can turn it into a ratio and have current assets divided by current liabilities. And you want to see that be greater than 1. And in some cases, a particular measure, 1.25, 1.5, 2, something like that. So that's something I wanted to bring to your attention, is that's what working capital is. It's this current assets and current liabilities measurement. So then the next one is the income statement. And this is just, like I said before, kind of a scorecard, provides an accounting measure of revenues earned and costs incurred. These are the major categories that we tend to see. Revenues, certainly, and then cost of goods sold is something that gets thrown around. Cost of goods sold for a contractor is the costs that directly impact the jobs that you're working on. So they're directly related. So it's your labor, your job labor, your materials, subcontractors, even things like permits and things of that nature can get folded into cost of goods sold. The cost of a surety bond can get thrown in there. And then below, so that, you take your revenues minus those costs, and that gives you gross margin or gross profit. That's something that a phrase that you'll hear quite a bit. And then below that are other costs that kind of support the business. Call it the corporate office costs, the office costs, administrative salaries, general liability insurance, office rent, things of that nature, all go into this selling general administrative expense category. And then that drops down to what's referred to as operating income. And then below that, you've got a few other things like the interest on your bank accounts, interest expense on debt that you owe, and other kinds of various sundry items that kind of show up down there. And then, of course, income taxes. If you're a C corporation, you pay income taxes inside of the company, and that shows up there. If you're an S corporation or an LLC, you're what's referred to as a flow-through entity. And so the entity doesn't pay income taxes. It all flows through to the owners in a K1, and the owners are who's paying the income taxes on their 1040, but not inside the company. So a few things I'll highlight here. So you think of the revenue and cost of goods sold, those are your service revenue costs, and overhead. That's another phrase that you'll hear. That's where those corporate costs come from, selling general administrative expenses. So something else I want to talk about is a phrase that you'll hear a lot, that kind of a weird phrase, but it's called EBITDA. And that's an acronym. It stands for something. It stands for earnings before interest, taxes, depreciation, and amortization. And this is something that when you're analyzing a set of financial statements, this is something that is used quite frequently. It actually is not defined in any way within generally accepted accounting principles, but it's just one of those things that analysts use to figure out if a company's doing well or not. And the reason it's important is that it's a simple way to figure out, what are the cash flows, the operating cash flows of this business? Are they positive? Are they positive enough that it's supportive of the other things that the business needs to do, like reinvest in capital, pay their income taxes, pay for distributions to owners, to do those kinds of things. So the other thing that EBITDA does is it kind of normalizes some activity that could be different based on the way that the company does business. For instance, you could have one contractor that has equipment financing, and because they have equipment financing, they are paying interest on that financing. You could have another contractor that's not doing that; they just paid cash, and their earnings might look a little bit different because this one, the first one, is paying interest, and so they have a reduced amount of earnings as compared to contractor number 2, who paid cash for their equipment. So this kind of normalizes that. It takes away the interest piece so that you can look at things apples to apples. Same thing with taxes. Taxes, you could have a C corporation and you could have an LLC side by side. And if you take away the tax impact, you'll be able to figure out, okay, well, which contractor is actually performing better than the other if you were to compare them. And then with depreciation and amortization, those things get backed out simply because they're not cash. My example earlier, you buy $100,000 piece of equipment, which means that you depreciate $20,000 a year over 5 years. You're not paying $20,000 in cash, but you're recognizing some expense because you're spreading the cost of that equipment over that period of time. You're not paying cash. So if you're really trying to measure the cash flows of a business, then you've got to back out the impact of that depreciation. So EBITDA, a kind of tricky concept, but something that really gets talked about quite a bit. So the next one is the statement of changes in owner's equity. And what I talked about earlier is this is one of those accounts that we zoom in on to make sure that we understand what's going on. And it's a roll forward of activity in each equity account. So this is something that, kind of common. Let's say this is an S corporation. They have some common stock and they've got this thing called additional paid-in capital, and then they've got retained earnings. Well, we start out at the beginning of the year, we end at the end of the year, and what we're doing is we're telling the reader what happened during the year that caused the changes in the account at the beginning and the account at the end. So maybe we issued some stock, and that meant that we had a new money coming into this column, and so this number changed. We paid a dividend or a distribution to our owners, and so that was a reduction of this retained earnings number. And then we recognized some net income over the year, and so that gets recognized here too. So it's just an accounting and a roll forward of activity that took place in the equity account. So the last one is the statement of cash flows, and this one is I think of as the most valuable of the 4 in many respects, although maybe the most confusing as well, just because of the way that it's built and what it's telling you. So what I'm going to try to do is explain the reasoning behind the how we build this, and then the value that it and what it's telling us. So there's 3 different kinds of cash flows, and if you think about all of the different transactions that a business does over a year, we try to fit them into 3 different categories. There's operating cash flows, so the revenue you're getting from your jobs, the costs that you're paying to support them, and things of that nature. There's what's called investing cash flows. Investing cash flows are you're investing in equipment. You're investing in even stocks and bonds and things like that. That's a transaction that needs to be accounted for. So you're making an investment in either buying equipment or selling equipment. The other is financing transactions and cash flows. So there it could be we took on a line of credit, and so we received cash by way of this line of credit, or maybe we paid off the line of credit. But that transaction is a financing cash flow item. So some examples, I'll get into the details here. On operations, typically the way that this is calculated, you take your net income. This looks a little bit like EBITDA. You back out the depreciation and amortization, like I talked about earlier. And then you back out other things that typically are non-cash related, like gains and losses in a variety of ways. For instance, many companies have been getting these Paycheck Protection Program loans, PPP loans, and if you spend the money in the right way, you can generally get those forgiven. And so what that looks like is a gain on your income statement, but you didn't really, you might have gotten the cash in year one and it got forgiven in year two. When you recognize that gain, you didn't get any cash for the sake of that income in year two. So we've got to back out that gain. And then, changes in working capital accounts, changes in other operating activities get accounted for here. And we come down to an operating cash flows number. So maybe we had net income of $500,000. And if we calculate, back out these various things, that turns into cash flows from operations of $400,000. So that's what that set of accounts is doing for us. And then we've got investing cash flows. Like I talked about earlier, we're making investments in capital expenditures, equipment that you're buying. Also, it could be, investment stocks and bonds and so on. And that comes down to a subtotal for investing cash flows. Same thing with this financing cash flows piece. You're maybe, adding to your debt load or paying off your debt load. You're making distributions to owners. That's also a financing activity. And that's a financing cash flows. And so then basically you take the sum of all three of these, and if you start with cash as of January 1st on your balance sheet, you add operating cash flows, you add investing cash flows, you add financing cash flows, you should come up with ending cash or your December 31 cash balance. So the way I look at this is, okay, is the business earning positive cash flows from their operations? If they are, is that enough to take care of the equipment investment that they need to make to continue to feed the business and keep it healthy and strong? Is it taking care of their ability to pay off their debt, to make distributions to the owners? Are they earning enough from operating cash flows to take care of the things that they want to do or need to do on the investing and financing side of things? That's the way that I read this. So anyway, like I said, tricky to kind of get used to, but really, really valuable information. So then beyond that, and I'm getting a little bit into the CPA prepared statements piece. Beyond that, there's a concept within the CPA reports called the notes to the financial statements. They're super important. They tell a lot about what's going on with the company. So I'm going to talk a little bit more about that. They in external financial statements, it's a required supplement. They go into greater depth about accounting policies and a variety of things, just kind of help provide some details about what's going on there, how you're recording the transactions, some level of detail about the components of accounts receivable or inventory or equipment and property, plant, and equipment. It helps tell the story. The numbers kind of on their own can be, may not tell all of the details without context. And so these notes to the financial statements provide some context around these transactions and what you've got going on, how the business operates and who you're doing business with. And is it with, do you have related party transactions, things of that nature get talked about here. So the notes to the financial statements are super important. Things that get included in there. So we have a description of the business and the reporting entity. Sometimes we have companies that are kind of a family of companies. It's a group of 3 different contractors that are consolidated or grouped together. Maybe there's a general contractor, and maybe there's a sheetrock contractor, maybe there's a mechanical HVAC contractor, and all 3 of those are combined together because they're owned by the same operating group. So if that were to be the case, we would describe what the reporting entity is and the kinds of activities going on. Could be just simple. We've got a general contractor, and that's it. Greater detail of general asset and liability categories. We talk about what is this and how's it recorded. A lot of details on how revenue is recognized from the contracts you have with your customers, the terms and maturity of credit and other long-term debt. We've got a line of credit. We have a balance of $100,000 on it, but our limit on the line of credit is $1 million. and its maturity date is February of 2023. So just give some information to the reader to help them understand what's going on. If there's concentrations, a good example of this, I've got a company that I work with, a contractor that does 80 to 90% of their business with Costco. They build Costco warehouses and depots. The risk, that's a wonderful relationship, and if you nurture it, it can be really fruitful. But the risk is, well, what if Costco decided, I don't want to do business with you anymore? All of a sudden, their pipeline would dry up, and that's a risk. So if we have heavy concentrations in business with a single customer, that's something that needs to be disclosed, just to give the reader some notice that that's going on. Related party activity is similar. If you're doing business with related parties, that needs to be disclosed. For instance, often an owner might own the building that the headquarters is based. And if they do, they probably put that in a separate LLC and then lease it back to the operating company. That's a related party transaction that needs to be disclosed, just to, again, put the reader on notice that maybe that wasn't at an arm's length transaction, as though they were completely independent parties. That's what we're getting at there. And then this thing called commitments and contingencies. So leases is a commitment that you've made that needs to be disclosed. If you're in the middle of a lawsuit, or maybe you're a union shop and you're in the middle of a bargaining, negotiation with your union, that needs to be disclosed as a, contingent issue that is pending, things of that nature. So apart from that, for contractors, there's some additional material that is generally included. We've got some supplemental schedules that provide additional detail on a variety of cost categories, and then a couple of schedules, one that relates to contracts in progress that users really like, and then a completed contract schedule. So the main captions you see here: total direct costs, total indirect costs, total cost of revenues earned. Those things show up on your income statement, but probably as just single line items. So from time to time, our clients say, well, I'd like to provide more detail. So we provide this supplemental schedule that breaks everything out and shows the different categories of costs, just again, to help the reader understand what's going on here. Same thing with general administrative expenses. When we were looking at the income statement earlier, there was just a single line. And so sometimes we, again, have this broken out into detail to provide some context around, well, what's in that thing? What other kinds of costs are going on? So just some additional details. So a contracts in progress schedule, or sometimes called a WIP schedule, work in process, is something that's required by GAAP. It doesn't have to be included in a CPA financial statement, although for my contractor clients, it almost always is. It's something that the users really key in on. Banks and sureties will want to look at this for different reasons. They'll want to know what does your backlog look like? They'll want to know how are your contracts performing? Are you earning good margins on them? It's just kind of a good look and snapshot of how the business is doing. It provides a summary of, like I said, job trends and opportunities, cash flow and billing challenges, and an idea of your backlog. How much work is remaining? So, and it looks, in kind of really high level, it looks a little bit like this. It's just a listing of all the jobs that you have in progress. It shows what are the amount of revenues that you've earned. What are the cost of revenues that went into those jobs? How much gross profit did you make? And then talks about how did that split up from year to year? So this is the completed contract side of things. And then the contracts that are in progress, so they haven't been completed yet. Same idea. We talk about what's the total contract price. How much in total do you expect to spend on that? So essentially, what's your budgeted gross profit going to look like? And then how much have you spent so far on the job, and how much is left to spend? So let's say it's a $100,000 project. You've spent $80,000 of what you expect to spend, which means there's $20,000 left, and you're 80% of the way through. The reason why this is so important is that in GAAP, revenue is recognized most generally based on how much cost you have into the project. So let's say it's a $120,000 contract. You expect to spend $100,000 in your own costs, which means you've got $20,000 of margin. If you've spent 80% of the cost on a project, that means that you get to recognize 80% of the revenue, regardless of whether you've billed it or not. You get to recognize 80% of the revenue on your income statement. And so this schedule helps us calculate what that is. Really important, and something, again, that the users of the statements really want to look at. So let's talk about the users. Banks, surety bond, landlords even want to look at financial statements from time to time, and investors. Banks and surety bonds, for sure. Surety bond providers are really the key users of financial statements for this industry. So we'll hone in on kind of what they're looking at a little bit closer here. So for banks, really what, they're going to get a set of financial statements to help them understand, is this company credit worthy? Are they earning enough money that we can loan to them and have some assurance that it's going to get paid back? So what are they looking for? They're looking to see, is the company profitable? If so, how profitable? How are they using their cash? Do they distribute every single dollar they make out to the owners, or are they keeping some of it in the business kind of as a rainy day fund, or to invest in equipment when you need to refresh that from time to time? Are they leaving some of it in the business, or are they taking it all out? That's a reason why we want to see those details in cash and the equity accounts. How do they measure it? So the banks, they'll look at that current ratio I talked about earlier, as a measure of, can this company pay its bills? So that's something that they look at really carefully. They'll look at, are they able to pay their debt service? Are they able to pay their principal and interest on their equipment financing, or the building mortgage, or the line of credit? And there's this thing called a fixed charge coverage ratio, or a debt service coverage ratio, that I'll talk about here in a minute. That's a common debt covenant that comes along with that. And then the amount of debt that you've got in the company, they look at a net worth ratio, or how much equity is there, either as a flat dollar amount, sometimes as a ratio, but the banks like to look at these different ratios. So I pulled some examples from a client of mine, an HVAC contractor, good size. They had a current ratio requirement where they needed to have current assets divided by current liabilities be equal to at least 1.3, if not more. We looked at that. Again, quite a good sized HVAC contractor. They had 33 million in current assets. They had 20 million in current liabilities. So their current ratio was actually above this mark. So that's great. They passed this threshold. They also had a debt service coverage ratio, which is what I talked about earlier. It's again a measure of their ability to pay their debt back. And they had a minimum requirement of 1.35. So they started out with EBITDA. There's that term again. They reduced distributions to owners because they know we want to pay those. Excuse me. And then what they wanted to see was, well, how much did you have to pay in principal a year ago, which was this $325,000, and then how much did you pay in interest, which is this $250,000. So for this particular contractor, they blew the ratio out of the water at 7.6, and they only needed 1.35. So again, another pass. And then lastly, they had a debt to worth ratio of not to exceed 3-to-1. So we're looking at their total debt, which was about $21 million. Their tangible net worth, or their equity, was about 15. So that's a debt to net worth ratio of 1.4, and that could be no more than 3. So they passed that one too. So these are the kinds of things that banks are looking at to figure out, is this company worthy of are we able to lend to them and have some comfort and assurance that they're going to pay it back to us? And so they use these different ratios to measure your ability to do that. So yeah, my challenge to you is, how would your numbers compare with these kinds of ratios, which in my experience, these ratios are fairly common. The measures, the the 3 on the debt to worth ratio, the 1.35 for the debt service coverage, the 1.3 for the current ratio. I think these are not uncommon as far as where banks are willing to lend. On the surety bond side, just kind of really quickly, they want to know what are the chances that they're going to have to they're going to have to perform on the bond. So surety bond is providing an insurance policy, essentially, that if you go out of business, you're unable to finish a contract and it's partially complete, that the owner of that project will be able to pick up the pieces, get another contractor in there. It provides an insurance policy to help bridge that gap and get the job completed. So a surety bond provider wants to know, am I going to have to perform on this bond? Do you have a healthy amount of reserve or equity that you keep inside the business, like I talked about earlier? Or are you distributing out every dollar that you make? Do you have a healthy amount of backlog to keep the business running smoothly and to keep cash running through your business? That's something that they really key in on. Are there any current jobs that are not performing well and that are maybe a potential drain on resources? Could any of those jobs hurt the business in the long term? So they really like looking at that contracts in progress schedule, that WIP schedule, to see what's going on here. Is this just kind of status quo, great contracts, same business lines that we've been operating in, or is there something unusual going on here? They want to know if your revenue volume is sustainable. How many jobs do you have that require surety bonds? And for the surety provider, how much credit are they extending to this business? How many bonds are they writing? Is the business overextended on its work? Are they performing too much? Or are they performing projects that are unusual for them? Things that, like that contractor I talked about earlier that builds Costco's. Are they all of a sudden going to build a school or a high rise? Something like that that's way out of their lane. That would be a risky proposition for that contractor. So the sureties like to kind of just measure risk. Banks want to know that they can be repaid, like I talked about earlier. And not only can I be repaid by way of these ratios and the operations of the business, that's kind of the primary source, but banks typically like to have a secondary or even a tertiary or a third source. Is there collateral? Is there a personal guarantee by the owner that they'll, if the business can't pay it, somebody else will? Why is the borrowing necessary? Do you need the cash to cover the cash to cash cycle that, you perform on a job, you've got to pay your employees, of course, and you invoice your customer, but it takes them 30 to 45 days to pay you. So do you need a line of credit to help cover that cash to cash cycle? I'd say would be an acceptable form of borrowing. Do you need it to fund an unprofitable product line? If so, a bank may not be interested in providing that kind of funding. Do you need help to buy inventory to fuel growth? If that's the case, yeah, maybe they would be interested in that. So operating lines of credit, they're often limited to qualifying receivables and inventory, which means that receivables can't be any older than maybe 60 days. If they are, the bank essentially says, well, the likelihood that you're going to collect on that is really not very high. So we're going to assume that you're not going to collect for it. And you can only borrow up to, say, 75% of qualifying receivables, things of that nature. So even they'll ask to have that certified from time to time, have a third party come in and check up on what your qualifying receivables look like. So the banks want to see historic profitability. They want to see some forecast of future business as well. So being prepared with budgets and projections and things is something that banks would appreciate. Like I said, they may also ask for third-party verification of financial statements from CPAs, which brings me to my next topic, the CPA financial statements. And there's 3 levels of service that are reports that CPAs will provide. So the base level, kind of as banks and sureties grow with a business, as a company grows, they start to ask for more and more complicated information. They may start out with, well, just give me your tax return and your internal QuickBooks, and that's going to be good enough. I'll look at that and we'll figure out if you're profitable and how much we can lend to you. Again, surety bond providers and banks are asking for this. As you grow, they may start to ask for something like it's called a compilation or a review or an audit. I wanted to talk a little bit about what all those things mean. So first, I'll just kind of acknowledge that there's this expectation gap around what a CPA report is. And the expectation is that, well, a CPA is putting their name on it. That's an audit. That company got an audit, which may or may not be true. CPAs provide 3 different reports, like I talked about. The first one is called a compilation, and it's the kind of simplest and most straightforward. All we do with a compilation is prepare a set of financial statements and the notes. We don't kick the tires. We don't check up on the numbers. We don't do anything at all. All we do is prepare these financial statements in the right format. Then we move up to a review. So with a review, we do what we did in a compilation, but now we are kicking the tires. We're asking some really key questions based on the information we're seeing. We're doing some analytical procedures and running our own ratios. And we provide what's called a limited assurance that essentially nothing came to our attention that suggests something's wrong. And then on top of that, you can move up to an audit, which includes everything we did in a review, but now we're going outside of the business to verify that certain information is accurate. So we may be sending a letter to your bank to say, our clients' records show that they owe you $100,000 on their line of credit. What does your record say? The same thing, we might be sending letters to your customers to say, our clients' records show you owe us $10,000 on this project. What do your records say? Things of that nature. We'll also look at source documents. If you bought a $100,000 piece of equipment, rather than taking your word for it, we'll say, well, show me the invoice, show me the check that you paid for it, and so on. We'll also study your internal controls. So with a review, we were saying nothing came to our attention that suggests something was wrong. With an audit, we flip that and we say, we're providing reasonable assurance. We haven't looked under every rock, but we've looked under enough rocks to get a really good feeling that these financial statements are right. So a review is nothing came to our attention to suggest something was wrong. In an audit, we're saying these financial statements are right. So that's what the CPA's role in the financial reporting process looks like. And as you grow as a business, and as you grow in your needs for capital from either a surety bond provider or a bank, you can expect to hear from them about these different things. And with that, I think I'm on the nose at 8:45. I see a few things in the chat here. I'm not sure if there's anything I can answer, questions. And obviously you see my contact information there on the screen as well. As I've given these talks in the past, certainly received questions, and I'm happy to talk about that offline as well. Feel free to email me or call with questions as you have them.
Well, thank you, Peter. It's outstanding, how comprehensive that you did this 45-minute presentation. And there's a lot of questions percolating. And I think that we could probably do 1 or 2 questions or comments at this time. If anybody has anything they want to ask real quick, or if they just want to make a commentary. Geezer, go ahead.
Good morning. How are you?
Good.
Good. Hey, we heard about the 60 days receivables or longer, and that might be a negative when looking at financial statements. It's been my experience that when I've gotten into large contracts, it's common to have receivables go beyond 60 or 90 days, but that doesn't mean that they're necessarily risky. And I just want to point that out, that it can be common depending on the types of contracts you enter into.
Absolutely. I agree with you. And certain customers can be notorious for slow paying. And part of that has to do with your normal credit terms. It could be that your normal credit terms with your customers are pay within 60 days. And so if it's day 60, in my book, that's a current receivable. It's not past due, it's current. Once you get past, you get to day 61 and you start adding on top of that, it can become 30 days past due, 60 days past due. And so if your standard credit terms are 60 days of payment, really you have to get out to 120 days in order for it to be 60 days past due. And so that's a negotiating point with the bank. If they are, kind of putting that kind of restriction on you about qualifying receivables, it's really helpful to just, help them understand, well, this is my customer, these are our standard payment terms. So it needs to be 60 days past due, not 60 days from the date of the invoice. It's a great point.
May I expand on that just slightly, please?
Please.
My experience as a subcontractor relating to this type of question would be, if we did, say, university work, there was the university that was going to pay the general contractor who's going to pay us.
Right.
So we would do our work, we would submit our invoice. The general contractor would then have 30 days within which to confirm that that was accurate, do their paperwork, submit it to the university, and then the university would do their work to make sure that the contractor was correct. So that made that lag time very common.
Yep.
And like I said, 60, 90 days was not uncommon. And we have to be prepared for that when we enter into these contracts, not just for financing purposes, but just for healthy cash flow.
Absolutely. Yeah, absolutely. I agree with you.
Thank you.
Yeah, just really, it's just something that the bank needs to understand, as the, if you're having a negotiation or talking with a new bank, it's good for them to understand that just operating characteristic, and that they're not imposing an impractical restriction on you. It's a good
I have
point.
another question for you, if you don't mind.
Sure, Geezer.
Okay, you were talking about recognizing income. And you said that if you had a contract for 100%, you spent 80% of the value of the materials going into that project, you could recognize 80% of the margin. Well, I'm not sure I agree with that, because you haven't really, in a lot of cases, put forward that 80% of the labor that might be included in that. For instance, if you have a contract for $100,000 and you're going to spend $80,000 in materials, the other 20,000, or excuse me, 10,000 in labor, you got $10,000 margin. So you spend the $80,000 in materials, you're kind of adding on to the labor portion of that when you use a strict percentage. Does that make sense?
It does. So, and I'll clarify that the way that GAAP operates is based on your total contract costs, not just materials. So it would be
exactly.
It would be materials, subcontractors, direct labor, all of the direct costs. So the measure of how complete is the job is based on total costs.
Understood. That's basically WIP.
Yeah, that's right.
There we go.
That's right.
Thank you.
Okay, well, thank you, Geezer, for bringing those items up. And Pete, we really appreciate all that you can provide to this audience. So, if you need more information or you have additional questions, please contact Pete through the resources that we put in the chat for you. And I did also post the Twitter account. So watch out, Pete, you might get some new followers today.
Super.
So with that, we are going to take a short intermission, like really short, and we're going to welcome our friends from, and I never get this right, is it First Fed Bank, not Fed First Bank. And we have Christine Walsh Rogers here. We have Erica Slatt and Jason Naylor. So we'll take a moment and we'll do some logistics here. So let's do like a 1 minute break and be back at 8:53. Thank you. And I'll ask
Okay.
So Andrew's on top of things. We are recording. So with that, I would like to reintroduce Christine Walsh-Rogers, Erica Slatt, and Jason Naylor from First Fed Bank, local banking office out of the Olympic Peninsula. So I'm going to hand this over to Christine, and your screen is shared. So off we go.
Thank you so much. I want to thank Lori Fazio for inviting us to be here today for this opportunity. I know that there were some bios included. I'll just say that if there's anybody on the call who's a business owner in the North Olympic Peninsula, there's a quite possible chance you've spoken to myself, Erica, and or Jason about PPP or other products and services at First Fed. Tomorrow we'll be celebrating my 2-year anniversary here, and I helped get the PPP going. And then I fortunately had Erica to help me pick that up. So we'll how you meet our team. I'll tell you a little bit about First Fed and the types of loans and products we have. We'll talk about SBA eligibility, other business solutions, and then we'll have some time for Q&A. So I think this will be less presentation and more conversation, hopefully, but I will go ahead and get started in telling you a little bit about First Fed. Oops, went a little bit too fast. So your speakers today are myself, Christine Walsh-Rogers. I'm the product strategy leader here. And as I said, I've just been here years. And I work with the retail banking area where I lead the strategy around our products and services and the customer's experience with those products and services. I will let Erica and Jason tell you each a little bit about themselves, but Erica is our VP of SBA and a commercial relationship manager. And Jason is a VP and Treasury and International Management Officer for First Fed. So they'll tell you a little bit more about their background, but I've been in banking for over 30 years, and I've also done a lot of community development work. I do a lot of nonprofit work with housing, healthcare, and trying to reach the underbanked and underserved. So those are some of my focuses in sort of my community work. So let me tell you a little bit about First Fed. And it's, I heard somebody stumbling over what to call us. We did just recently rebrand our bank as First Fed Bank to kind of simplify things. There's a lot of First Federals in the country, and everybody kind of called us First Fed. So we just decided to go with it. And that way we can differentiate ourselves from every other First Federal in the country. So we are so excited that we're about to celebrate almost 100 years of service. Next year is our 100-year anniversary in 2023. And I'm sure if you're on the North Olympic Peninsula or in any of other service counties, you'll see some of our celebrations around that. We are a full service bank, and that includes a number of products and services. But because you're business owners and business folks, I really wanted to focus on what products and services that we have that might be helpful to you as business owners. So we offer mortgage lending, both purchases and refinances. And refinances are a great way to go sometimes to access funds if you can't access them through normal business loans and commercial financing. We also participate in a number of programs that are out there, like USDA, which I know has benefited a number of small farmers in our area who have homes located on small working farms using USDA loans. We do veteran programs, the VA programs. We do the Home Possible Advantage programs. And we also have experience working with unique properties, and we understand some of the unique needs of people who are homeowners on the North Olympic Peninsula. So please, if you ever have any needs like that, reach out and we can connect you to the right loan officer. We also do consumer lending, which is another way that can be helpful in some of the your needs as business owners. Home equity loans and lines of credit have long been a popular solution for bridging some of the expenses for small business owners. Also, we do auto, boat, and RV loans where you can, sometimes secure commercial vehicles with those, or just take equity, if you will, out of your other toys and things like that to help keep, fund your business. And then we have unsecured loans and lines of credit, which are always a great solution for that rainy day expense that you just didn't know you were going to have and might need to pay for quickly. I mentioned that I do a lot of products and programs for the underbanked and underserved. And the reason I like to mention them to you as business owners is sometimes you're also employers. And we have found that these programs can sometimes help the employees of certain types of businesses. So we offer bank on certified checking, which is sometimes known as a second chance checking for folks who've had some issues before. But it's also a program that can be used for people who are having ID challenges or other challenges with address stability and things like that. And to go with that, we have a credit builder account, which helps somebody both build credit and a savings asset of somewhere between $1,500 and $2,500, depending on the program that they choose. This program we are really proud of, and we've seen some great success where people who just had never been able to access credit at all started a credit builder. And just before Christmas, I got my best good news story, which was that somebody got a $50,000 car loan because now they had a 722 FICO score as a result of participating in credit builder. And because of credit builder, they also had the down payment money for the car. So I do think that this is a great program that can really help some of your employees with economic empowerment. And we know that strong, economically empowered employees do help create stronger workplaces. And then another service I have, in case any of you are home improvement contractors, is we are a participant in the Lone Star Merchant Lending Program, which allows for point of sale unsecured loans to folks for HVAC, roofing, plumbing and septic, or other types of home improvement products and programs. If you have any interest in something like that, you can reach out to me directly. I am working on that program right now. All right, so I'm going to move into our next slide. Whoops, I think I went. Oh, is Erica on?
I think Erica's going to be on in like 5 minutes.
So Jason, what I'm going to do is jump ahead to your slides, and then when she comes back, we can move back to hers if that works.
Sounds good.
All right. So
Erica
I hope
Erica is on. I'm on.
Oh, are you ready? I can come back to you very easily. There
I'm
you
just
are.
trying to get the meeting. I'm just trying to get the Zoom to open up for me.
Okay. Well, I think we can probably either give you a moment, or if you'd like Jason to jump ahead for you, I can scroll to him and then we can pass it back to you after.
Yeah, go ahead and let Jason start, and then I'll go ahead and take over. Sorry about that.
Nope, that's okay. Jason, there you go. I think that's your first slide.
Well, thank you for having me. My name's Jason Naylor. I'm the Treasury Management Officer for the bank. So what does that mean? Well, typically an individual, as Christine alluded to, typically an individual or a business owner or a member of an organization or business structure will approach your local financial institution like First Fed or a community bank for the important need of credit, right? And that's really what this meeting is all about. But what comes next is a need to have sort of a fuller and direct banking relationship. And that's really where I come in. So my day-to-day is usually filled with connecting with businesses and connecting with the people that do sort of the daily, the daily accounting work or daily banking work for a business, so that they're put in the best position to succeed. One thing that's just true about the banking world is business owners are amazing people that are fantastic at what they do, right? The services and the products that they provide to our communities. but sometimes they need help with the banking, right? And so beyond just having a transactional relationship with the community bank, they need sort of that specialization, somebody to come in and help them with really two key and important concepts. One is, what does that account architecture look like? What do I need? How many accounts do I need? How do I run what we typically refer to as payables and receivables for my business? How do we run them most efficiently through the accounting structure or accounting architecture? And then two is, we are evolving as a society and as a business community in a digital way, right? And so if you don't have access immediately to that branch or being able to visit the branch, what does that mean? How can the bank assist me and with concepts like online banking and cash management tools that allow me to check my balances, but also take care of my payables and receivables on a daily basis? And that's how I help businesses, right? And so as I came into First Fed 2 years ago, I've been working on building those relationships with our business community, especially businesses in Clallam County, on exactly that. And the first, when we think about small businesses, the first things are making sure that we have the accounts and the competitiveness in our accounts, right, that meet the needs of our small business owners and our small business community. And we really do that. And the first one that we have, we so aptly titled it Everyday Business Checking. It's got a monthly maintenance fee of $5, but one of the concepts that I love about this checking account is, as we procure a more digital society and we promote that, just using e-statements for the account is able to waive that fee. So you're able to access an account or multiple accounts using the e-statement apparatus, and you get 50 transactions per statement cycle that are free. And for every one after that is 20 cents. And it tends to be a competitive product. We find that this is one where, we typically, I think we would typically see revenues for the business. What are we talking about here? Much less than $1 million, right? But the crucial businesses that we see in our community would really need access to this kind of checking account. And banks sometimes don't focus on this type of business because they're too small. And one of the things that I appreciate about First Fed is that we do focus on this type and size of business. The next one we would call the advanced business checking. Next slide for me, if you have the ability to switch it for me, Christine. And the advanced business checking just allows more transactions, right? Because as your business grows and the revenue sizes grow, obviously there's more people you got to pay and more people you have to collect from. And when that happens, your transaction total goes up. And we have the advanced business checking that's got a monthly maintenance fee of $10 and a minimum daily balance of $2,500 or $5,000 average daily balance. So again, a very competitive product that allows you to have a small average daily balance, right? You don't have to keep large balances in order to have access to this kind of checking account. And this allows the first 200 transactions to be free. Next slide, if you don't mind for me, Christine. So along with access to accounts that are efficient for our business community, the next thing that you're going to need is access to those digital components like online banking. Well, we do have a consumer online banking piece here at the bank that allows business owners, small business owners, any business owner to log in, be able to transfer between accounts, be able to pull an electronic statement, be able to look at your transactions, be able to get a little bit of detail on those transactions, right? Be able to take care and serve the basic needs for the account each and every day. We do offer more premium online banking solutions for businesses that need more cash management tools. And what's great about First Fed is we now offer a mobile app, which is quite honestly, I think it doesn't even need to be said that at this point, so many people expect to do business and expect to be able to do things like banking now on their smartphones. And so we have a mobile application that also has a mobile deposit feature that allow businesses to take pictures of their checks and deposit them right into their business accounts. And of course, that is all complementary with your business account relationship here at First Fed. And something we're excited by, and I think provides a level of need and service for our small business community. And then next slide. And then finally, I wanted to touch on one of the important pieces that we see in small business ownership, which is receivables, right? Like allowing our clients, our customers in business ownership, more ways to pay us for what we provide to them in the community. And one of those is obviously credit debit cards. So what we did last year at First Fed, Christine and myself worked heavily on the project, was to go out and procure one of the most competitive and best in class, best in industry partnerships with First Data Clover to allow our business owners the ability to process credit and debit through a merchant services relationship. We've seen tremendous success thus far in onboarding this crucial partnership and relationship, and the ability to, again, allow a business owner to have their customers have more options to pay and to provide crucial savings and data and insight, because Clover is not limited to just the payment apparatus, but they can do like invoice builds, they can do like web-based payment builds. All of those things have become like part and parcel of what a small business expects to be able to do through a bank, and First Fed is providing it. And again, the individuals such as myself, that's really what we concentrate on, is that important feature. So with that said, I will sort of turn it over to Erica, who will talk about sort of the main component piece here of the SBA lending.
Good morning. I apologize for being a little bit late there. Can you guys hear me?
Yes.
Yes, we can.
Yes.
Thank you. Okay, so I'll talk a little bit about SBA loans. We're new to SBA here at First Fed. I came over to help develop the department, and we've been doing it for about a year, but I have approximately 12 to 13 years of SBA experience. SBA loans are great for any business, from startups to seasoned businesses, and they offer some terms that you don't see with conventional financing, or if you're unable to get conventional financing due to a collateral shortfall or just lower down payments. So SBA is going to offer longer terms when it comes to maybe equipment and working capital, or if you just need inventory. Down payments or equity is as low as 10%, and it can go up to 20% if you're a specialized industry. But most often it's just 10% if you are going to purchase real estate or maybe some new equipment. There are circumstances where we can do 100% financing, and I'll talk about that in just a little bit. The payment options are principal and interest. There are no balloon payments when it comes to SBA financing, so it's fully amortizing. And you don't have a prepayment penalty like you would on some conventional deals when it comes to real estate. All loans with 15 years or longer maturity only have a 3-year prepay. but any loans under that 15-year mark, there's no prepay on those. Again, SBA can mitigate for collateral shortfalls, so we're not looking for one-to-one collateral, and we can't decline a loan because we don't have sufficient collateral. So you'll see companies come in that maybe need some working capital and they really don't have any assets, or they have minimal assets, and say they're looking for working capital of $1 million, but they may have $200,000 in collateral. We can't decline that loan, but we are going to look to personal assets to make up that collateral shortfall. So we will be looking at, personal residence and any other assets that the guarantors may have. Christine, if you want to move to the next slide. SBA loans are great for buying equipment, again, real estate, inventory, or working capital. We can also use them for a refinancing business debt. I'll give you an example of what I did this past year. Is we had a client who had purchased multiple pieces of machinery, but through different banks, because he really didn't have a bank that he had a relationship with. So he was going from bank to bank. And we refinanced 27 loans into one loan, saving him $32,000 a month in payments, and then extending his term out to 10 years. So that was a significant cash flow savings for them, and then just making it one payment. So we would really go through and looking at some of the businesses, looking at your balance sheet and seeing what loans we can consolidate and extending those terms for you to save you that cash flow. And then also you can use SBA financing for purchasing an existing business, or if you're a partner in a business and you want to buy out the existing partner so that you own 100% of that business. Christine, if you want to go to the next slide. So we'll look at, the terms of the SBA loans can be from 7 to 25 years. So working capital, we're going to do 7 to 10 years on working capital. A majority of them that I've done, we always extend it out to 10 years. Equipment can be between 10 and 15. It really depends on the useful life of the equipment. And then owner-occupied real estate is up to 25 years. Most of them I've done has been 25 years. And then the nice thing about SBA is you can blend the terms. So if you're buying real estate, and then you also need to buy equipment, and then you need to do some leasehold improvements to the real estate, and you need some additional working capital, you can roll that all into one loan. And if 51% of those loan proceeds are going towards the real estate, we can extend that term out to 25 years. Now, if less than 51% is going towards real estate, we can do a blended term, and usually it comes out to about 16.5 years that we could look at that. Another great benefit you'll see is if you are leasing your current location and you decide to buy that, we can do 100% financing on that through the SBA, whereas on conventional financing, you're looking at maybe 20 to 30% down. SBA will allow us to do 100% financing, which is a great opportunity for businesses to purchase their building. Christine, if you want to go to the next slide, please. We also have the 504 product, which is mostly used to purchase real estate or land that you intend to build on. You can also use it for equipment if it has a useful life of 10 years or more. The 504, I don't have it broken down, but it does have really attractive terms. And what happens is the bank takes on 50% of the loan. The CDC, the Community Development Center that we're going to work with, is going to do the 40% of the loan. And that's the SBA portion. And then the borrower is going to bring in 10%. So it's 50, 40, 10. And this also is a great program if you're purchasing real estate and you want to have that lower down payment. Now, the bank is going to price their portion of the loan like they would any conventional commercial loan. And then the CDC loan, the 40% loan, is based off of the debenture rate when the SBA takes it out. And those rates currently are 3.22, and those are fixed for 25 years. So right now, if you were to do a loan for $1 million, the bank would take $500, the CDC would take $400,000, and you would bring in $100,000. That $400,000, if it was taken out this month, would be locked in for 3.22 for 25 years. Those loans are assumable, So if you were to sell your building and close down your business, the purchaser could assume that 40% loan and then get a conventional financing for the rest of it. Both products are great. And some people think that SBA loans are only for businesses that aren't doing well. That's not true. We have a minimum debt service coverage that we do look at, and there has to be liquidity that we're also going to look at. When COVID hit, a lot of businesses, saw a decline in revenues and profits. So we can use projections, and we will use two years of projections. So if you have a negative net income in 2020, 2021, we will allow the use of projections to do the financing. And that's another advantage of the SBA loans that you don't see on the conventional side. So just to recap on the
Erica,
7As.
Yeah,
Yeah.
Erica, this is Leslie Miller. We had a question in the chat from Debbie Fuson, who wanted to know if SBA loans to nonprofits.
We don't do SBA loans to nonprofits, but there was a little spot in the SOP, which is the standard operating procedures. It's a little bit about nonprofits, but they have to be tied to a business that's for profit. But I would be happy to get that information back over to you guys. But yeah, what we saw with PPP is that nonprofits could get the PPP funds, but they can't through the regular SBA program, unfortunately. But I can get all the details on the little bit of information that's in the SOP and what does make a nonprofit eligible.
Thank you.
And any other questions on that? I mean, it's a great product for even if you're looking to purchase a building and you want to go conventional financing, but you only have that 10% down. I kind of say that the SBA 7A loans is kind of a bridge loan. You can purchase your property and maybe do a little bit of TIs with as low as 10% down. And then within the 3 years, once the prepayment has passed, you can refinance that into conventional financing. SBA loan rates are going to range between institutions. A lot of them are based off of prime, which First Fed bases their loans off of prime, and it is variable. Prime plus, they can go up to 2.75 on the larger deals. So again, it's great for a bridge loan if you're looking to get into a building and maybe have 0 to 10% down. It is great for working capital. We are seeing a lot of working capital loans right now for businesses that just need a little bit of capital to make up for any losses and just to ramp back up while we're going through this stage right now.
Erica, this is Lori Fazio, and there is a question in the chat from Debbie, and it says, does SBA work with nonprofits?
Yeah, so Lori,
We just answered.
oh, sorry.
Did you just answer that and I missed it?
Yes. Yes,
Okay.
we did.
Sorry about that.
That's okay.
No, thanks. I think there's 3 of us monitoring that because I'm also making sure we're answering the questions, and so is you won't get missed if you've asked one. We'll make sure. Eric, are you ready for me to advance?
I am. So SBA, to be eligible for an SBA loan, you do have to be an operating business and organized for profit. You do have to be in the United States. Now, say you have your main operations are in the United States, but you have some operations in Canada and Mexico. It depends on how much of those operations are located in each country. We can still look at financing you. And you have to meet the criteria of small. It's 15 up to 15 million in revenues and a net worth of 5 million. A lot of businesses meet this just based on how we can look at the net worth of the company. And also you have to be a U.S. citizen. We do see some companies where maybe a partial owner or an owner is 40%, the 40% owner is not a U.S. citizen. We can still work with that. We just have to verify the status, but at least 50% of the ownership has to be a U.S. citizen. But we do at First Fed, we do have there's 3 to 4 of us who do SBA loans. Again, this is a new program for First Fed, and it's been pretty successful for us. We are not a preferred lender provider yet. We are working on that status. We do work with a loan service provider to help us package and close our loans for a efficient process for our clients, and so that we can move them through the process a little bit quicker and get those approvals through SBA. And I think that's all I have,
So
unless there's
Eric,
any other questions.
yeah, Erica, this is Leslie Miller again. In regards to the loan eligibility, if I am a brand new company, started this year, and I have lots of experience in the industry, but my company is brand new, what's the feasibility of getting any kind of loan or being eligible for a loan? Because I have no financials.
What we would do is we would look at your personal financials, your personal financial statement and your tax returns, and then also those 2 years of projections with detailed assumptions, and then a business plan. I refer a lot of my clients to the SBDC. It's the Small Business Development Centers. They will help put together the 2 years of projections, plus help with assumptions, and then a business plan. They work with a lot of SBA lenders, so they understand what SBA is looking for. And this year I've done a couple startups, but I mean, that's why the SBA program is there, to help businesses get started and employ people. So there is not an issue if you are a startup. You just have to have a good business plan in place, and we are looking for that management experience of running a business, a similar business.
Thank you.
Leslie?
Yes.
We have Micah Jonay on the call on the class today, and he is for the Center for Entrepreneurship. He works with startup businesses. So if it's okay, if Micah just shares real quickly, if we have just a short minute of time, he could also enter his information in the chat.
Yes, please go ahead and do that. What we'd like, if you want to contact any of these individuals, we have all this information available in our digital Dropbox that Andrew had just posted a moment ago. But if you have any questions or concerns, reach out to any of the team, that you've received correspondence from, and we can follow up with you. The whole SBA resource is a critical aspect for the community, and particularly for small businesses and federal government contracting. So Christine or Erica or Jason, do you have like annual reports on the demographics of the types of companies that you've served, woman-owned, veteran-owned, minority-owned, HUB-zone, and does that factor at all into your goals for the year?
I can get those annual reports. Right now, if you're looking just for a First Fed, we've closed 11 SBA loans so far, and it's a mixture of women-owned businesses, and then I am working on a couple of veteran-owned businesses right now. We don't really have goals set to, what kind we're looking for, if we're looking to do more women-owned or this or that. But I would be happy to get those numbers over to you.
And I think that would really benefit, Laura Fazio and Colleen at the Economic Development Office, and the agencies like SBTRC and Washington PTAC are also interested in the services that you provide and how that can dovetail into our organizations. And I think that with that, I'm going to turn this over to Aisha, if she has a minute, to talk about the services that the Northwest Small Business Transportation Resource Center provides to the region. And by the region, they have a huge footprint. So Aisha, do you have a minute to speak about that?
Yeah, absolutely. So as Leslie said, my name is Aisha and I run the SBTRC for the Northwest region. Throughout the United States, there are 11 regions. So this particular region covers the states of Alaska, Idaho, Montana, Washington, and Oregon. And we help run the bonding education program for the Department of Transportation. We also run the Women in Transportation Initiative. And then we also help small businesses with counseling as well as funding opportunities. And so I'll go ahead and drop my name and email in the chat. And then if you guys have any questions or want to connect with me after this, just go ahead and send me an email and we can connect.
Thanks, Aisha. We're getting down to the wire here, but if anyone has any comments or questions about what all they do at First Fed, we're happy to answer them. And then I see that Micah included his information in the chat. And actually, I would like to hear from Micah as in regards to what your agency is all about. I don't know if he's still on or not.
Yes, he just unmuted himself.
Oh, okay.
You hear me now?
Yes, we can. Welcome.
Perfect. Thank you. Yeah, so I'm Micah. I work for the Center for Inclusive Entrepreneurship. We're a subcontractor for the SBDC here in Washington State. And we work with both startups and existing businesses, but we really focus on the smallest size of business and the least well-capitalized businesses. We really stress like a minimum viable product. You start with what you've got, who you know, and what you can do, and kind of build from there. So a lot of our clients are kind of scrambling together a business, and then they'll hit a point where they do need money because they can only pull themselves up so far. So it's good to hear that you here at First Fed are doing so much with the SBA.
Well, thank you so much for sharing. So if anybody else who is still logged on would like to make a comment, we'll open it up for you. So thank you.
I want to say right now, at First Fed, we don't have our Express program up, but we are looking into that. We do have a program called Excel, and I can send this link out as well. I don't have it to put in the chat right now, but it's kind of a quick close process. And what I mean by quick close is 30 to 45 days. But it is an online app that you just go in and put in a little bit of information, and you are credit scored. It's called the SBSS credit score. And then it goes through this process with our loan service provider, and they're great with working with the clients, and you're still connected with me. And so I'm on all the emails and helping you work through it. But it's a great opportunity for businesses looking for those smaller loans between 100 and 350,000. If you can credit score at 155, which is kind of a combination of your personal score, I believe, and just the business, it is a really quick process for borrowers to get funds in hand. And so that is an option, and I will send that out to Leslie and Lori. Would I send it out to both of you, that you can share with the clients? And it's just a really quick application. And if you do credit score, and then you'll be reached out from our LSP with me included to help you through that process. And that's been a great option for some of our businesses looking for those smaller loans, so that they don't have to go through the standard SBA process of 60 days or more. So I'll get that information out for you.
Thank you, Erica. And when you send it to me, then we'll go ahead and drop it in our digital Dropbox. So all of those resources will be available to our participants. So thank you for that update. And I see where Geezer, did you have a question, Geezer?
I have a couple of questions. I've been taking copious notes and regarding the business plan that we heard earlier, is there assistance in producing a business plan for somebody that might be seeking an SBA loan? I think that was Erica that mentioned that.
Yeah, and I mentioned the SBDC. They will assist in doing the business plan. And Micah, is that something you'll also assist in?
Yeah, that is
Being,
something. Yep, yeah. Since we're part of the SBDC network, we're able to do all of the same stuff they can do, and we have access to the statewide network of SBDC advisors as well. So if somebody comes to us trying to get a business plan, and they're going to be the first of the kind on the peninsula, one of our colleagues in Eastern Washington has often helped work a couple of people through that exact business idea.
Beautiful. Thank you for that.
Mm-hmm.
So Geezer, in regards to resources, if you're brand new and don't have a clue as to, how you're going to do this business, PTAX, will generally recommend like the Service Corps of Retired Executives first, but then the next level, which is the heavy lifting, is the small business development centers. And, on the Olympic Peninsula, and then having Micah's organization there also. And, and some of the things that the SBDC does is more in-depth in regards to cash flow projections and, some of the accounting criteria. And, so, and if you're going to be doing government contracting, you really have to pay attention to your accounting software, because if you're doing anything with the Department of Defense, they frown upon things like QuickBooks. And so you have to make sure that you have some really good resources, depending on what your ambitions are. And, larger companies like Clark Newber, but I would think that on the peninsula, there might be some smaller accounting offices there that might be able to help you through that. And the reality is QuickBooks is subject to a lot of manipulation and fraud internally. And so the federal government does not, they really don't want you at that bottom level of accounting. And, they would recommend that you upgrade to Peachtree or, some of the higher level ones, but, that's between you and your accountant.
Sure,
And,
I appreciate that. Yeah.
and then, if you've ever had to undergo a DCA audit, and, Pete kind of alluded to this earlier, getting through a regular audit is tough. But if you go through a federal audit, you better have your T's, crossed and your I's dotted, and, every piece of supporting documentation in line. And it's very thorough. So on the accounting side of things, having a really good accounting resource, not everybody can afford to hire a CPA right off the bat, but it's all about who you know. And, the economic development, the Fed First, Pete Miller, these guys can make some recommendations for you on a local stage. So just keep that in mind.
I'll do
So
that. Thank you.
any other questions, Geezer, or anybody else?
Yes, I have a question regarding the Lone Star program. How does that work exactly?
I'm not familiar with that. So maybe Christine or Erica or Jason, are you familiar with that?
Yeah, that's a program I've been working with. So Lone Star is a program where it's basically a technology software solution for providing a point of sale unsecured loan as a contractor. And your customer is provided a link to apply for a loan with First Fed, which we either instantly approve or not. And then they're funded for, let's say, an emergency septic repair or an unexpected expense. This is not somebody who's planning a project and taking out their home equity, but really for that person who is, surprised by this $30,000 to $35,000 expense and doesn't want to put it on a credit card at 25%. These loans are unsecured at about 7 to 10%, depending on the customer's credit and how much they might be borrowing and for how long. We're just getting started with this program, just getting our first merchants enrolled in it, and we're really excited about it. But it's a really just simple solution to some of the problems that, I know homeowners face, but then also our contractors face in wanting to get the job done, but, not wanting to take the risk that they're not going to get paid their $15, $20, $25 ticket.
So it's more for emergency type applications and not for general home improvement.
I think it can be used for general home improvement, but just having a lot of experience with people's borrowing habits, I think that people who are planning to do a $40,000 project, right? They usually have figured out their financing ahead of time. So a lot of times I see this more as that solution for either a spur of the moment thing that you do that you didn't plan, or that's something that comes up as that emergency issue, right? Where you surprised to find out your septic system just failed.
Got it. Okay, then I have a question around the Clover credit debit service. Is that something that's similar to Square, where you can do point of sale right from your smartphone or computer?
Yeah, Jason, are you still on? I believe that is one of their very many solutions. Clover is got a number, and yes, I know there's a point of sale solution. I believe there is a smartphone solution as well. Jason, are you on?
Yes, that's a great question. To answer the first part of the question, one of the great things about First Data is, as they own Clover, Clover is a direct competitor to Square. So they really aggressively tackle the same sort of marketplace. And so, yes, they have what we call the POS or point of sale products that allow small business owners to be able to take credit debit on a smartphone or right from their kiosk or in-store marketplace. What's so dynamic about First Data Clover is, we have people that, do the farmers market circuit, right? That have the little pluggable device for the smartphone, and where they can take credit debit, all the way to much larger businesses where they have multiple POS systems for multiple locations.
What are the general fees for that?
So sometimes the lease equipment is built into the contract with Clover. Sometimes you can buy them outright. I don't have the specific details. I can provide some general ideas of what the pricing are. I will tell you that depending on the makeup, usually with the ones that plug into the smartphone, you usually can buy those outright from between $75 to $150, right? And then the larger POS equipment can be more expensive, but again can be baked into the interchange and fee rates that they take every month.
I was more concerned with the fee rates from a customer if I were to use that service, not the purchase of the device itself.
Oh, I see. Yeah, so they're competitive on the interchange, right? Obviously, they don't have standardized pricing, so they take everything in based on credit worthiness, so they underwrite you. And then that's really where they will get the plus over the interchange, because the interchange, just for anybody who doesn't understand, interchange is the credit card provider's fee, right? So Visa, MasterCard, right? American Express, that's their fee, what we call interchange. And then the merchant service provider, in this instance, Clover, will take a plus over the interchange. And that's all based on how the business goes through underwriting.
Good, okay, thank you for that.
Yes.
So Jason, I have a quick question in regards to Clover. Does it also do payroll like Square does?
Yes. Yep.
And
So-
does all the back end taxes and everything behind it?
Yes. Yeah. Now,
Excellent.
obviously, those are, they have a multitude of services. All those services can be looked at, payroll provision, invoicing for clients, like all those kinds of things can be done. What's important for those kinds of things is, and also for taking credit debit is they're going to see if you use, if your gateways or your accounting software is compatible with them, right? And if it's not, then it's either the business has to make a change or they have to find a different provider. And also, is some of this proprietary? Because a lot of businesses will use proprietary stuff and then Clover might not be able to connect to it or adapt to it. But yes, those are all premium, kind of like premium edition services. So again, not standard pricing, but something that could be looked at. And someone such as myself would help be the medium individual to help connect you to First Data Clover. And what's important to understand about your banking relationship is if someone such as myself, a treasury management officer, is doing their job how I feel correctly, what we are is we're really the advocate for the business owner. So the business owner uses us and then we go to Clover on their behalf and we really advocate to get them everything they need at the best pricing possible.
Well, thank you, Jason, and Christine and Erica. This was a really thought-provoking little session that we had here. There's always so much more than what the regular small business, can understand about opportunities and resources. So I'd like to thank Fed First for showing up today and bringing this really dynamic team. And with that, I think I'll turn it over to Lori for a few closing words, and then we'll call it a day.
Once again, I want to thank everyone for being on the call. So glad you could join us. Jason and Christine and Erica, your expertise in this field. And I do have a direct line to each one of you, so I will make sure to communicate any type of business resources from First Fed to any of the clients that we work with, small businesses here at the Economic Development Council. And once again, Micah Jonay will be able to utilize First Fed as a resource also for the Center for Entrepreneurship. And I think that is a great connection. And then Geezer, if you need any assistance with anything, make sure to reach out to myself. And once again, Leslie has mentioned that the slides will be in the Dropbox, so that would be able to be resourced by anyone that is in attendance or that I can send out to those or put on our website. So thank you again for joining today.
Well,
Thank you.
Thank you, everyone. And Micah,
Thank
we'll
you.
get your email address on our roster, and Andrew will follow up with all the links and resources for you. So thank you to Clallam EDC. Thank you to Northwest Small Business Transportation Resource Center, North Peninsula Building Association, and Kitsap Bank for making all this possible. Tomorrow, we're going to have a really great presentation on the legal aspects of contracting by Mr. Graham Ralston, a hometown boy in your community. And then we're going to do our capstone with Vanner Construction Management, all about bidding and estimating. And it's a tag team from Vanner that really knows their stuff. So hopefully you'll be able to participate tomorrow also. So with that, Andrew just posted the link again. So we'll call it a day and hopefully we'll see y'all tomorrow.